Yeah, welcome. So, vast topic or the concept we're going to look at in ICT or my strategy, that is, we're going to look at market structure. So, we will begin with the introduction. So, introduction. So, market structure. So, what is market structure? Market structure is basically how the market is moving. Sit in an uptrend, the market moving downtrend, or is the market ranging? Okay, so production. So market structure is how the market is moving. Is the market moving upwards? Is the market moving downwards? Or is the market moving horizontal? So before we go further, what you are going to look at draw this mentorship. Yeah. So introduction. Market, the market, the financial markets, that is moved by an algorithm or an artificial intelligence. Okay. So the markets, these financial markets, they are moved by an algorithm or an artificial intelligence or AI. Okay. So an algorithm is a program with instructions on what to do and when to do. Okay. So the market algorithm, we call it IPDA. Type that out. Call it IPDA. IPDA means interbank price delivery algorithm. So the market algorithm or the market AI, we call it IPDA, so interbank. Bank price delivery algorithm. This algorithm, the IPDA, is the one that moves the financial markets or all the financial markets. So no exceptions. May it be stocks, may it be currencies, may it be government bonds, everything financial market is moved by this algorithm, the IPDA. So what I'm going to show you, everything I'm going to teach you, back in your mind should always remember that these markets are moved by this algorithm, the interbank is inter. So interbank price delivery algorithm. This is the algorithm that moves the market. So what I'm going to show you, what I'm going to teach you is the algorithm, the algorithm itself. How does the algorithm book price? How does the algorithm move price? How does the algorithm move, how it moves, and when it moves? So in that, I'm going to teach you price and time. Yeah, so market is moved by an algorithm, the IPDA, and an algorithm is a program instructions on what to do, when to do, right? Right, so from that, introduction to market structure. So financial markets move in three directions, only three directions. Can either be in an uptrend, that's one, uptrend. Uptrend, we call it bullish. Of course, I'm not dealing with newbies or someone who is starting off with this course, because this is an advanced price action program. Okay, so you should have done the basics by yourself. So uptrend means bullish. So the financial market moves in three directions: either uptrend, which we call bullish market structure, downtrend, which we call bearish market structure, and horizontal, or what we call a ranging market structure. Okay, so in a bullish market structure, so the first one is the bullish market structure. Let's look at the bullish market structure. In a bullish market structure, we have price moving in a series. The price moves in a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. This is a bullish market structure series. Price will move in The price will create a new higher high, retrace, create a new higher low, rally, create a new higher high, drop, this is a retracement. We call this a retracement, create a new higher low, then rally, create a new higher high, drop, create higher low. So a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. This is a bullish market structure. Okay, right. So in a bearish market structure, price moves in a series of lower lows and lower highs, lower lows, lower highs, lower lows, lower highs. What it does, the market will drop, create a new lower low, rally to create a new lower high. So in lower highs, this is where we look to enter for sales. Then the market drops, create a new lower low. The new lower low, rally, create a new lower high. After a new lower high, the market will drop, create a new lower low. And the new lower low, market will rally, first, create a new lower high, then drop. This is the behavior of the algorithm. This is how the algorithm moves. Yeah. Okay. And in a ranging market structure, a ranging market structure is the horizontal market. The market is not either creating higher highs, higher lows, higher highs, higher lows, or lower lows, lower highs, lower lows, lower highs. It's just moving horizontal. In this scenario, we have highs and lows, highs, lows, highs, lows, highs, lows. So this is just the basic introduction to market structure. Yeah, so always remember this, and this is what we are going to build on. Yeah, okay. So I'm going to delete all of this. So mark out that bullish market structure. We create this series of higher highs, higher lows, higher highs, higher lows. Bearish market structures, we create a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. And in a ranging market structure, we create highs and lows, highs and lows, highs and lows, highs and lows. This one, we're going to look at deeply when we start the liquidity lessons. Yeah, you will understand. So this is just the introduction. And always remember that what I'm going to teach you is the algorithm of the market, which we call the IPDA. That's interbank price delivery algorithm. So the market is moved by an algorithm or the artificial intelligence, I mean, and this is a program with instructions you want to do, you want to do. So I'm going to delete this, dive deep into this. So I'm going to delete all of this. Right there. So next we are going to look at dealing ranges and break in market structure. Okay, dealing ranges and break in market structure. So this should be, we are still on market structure, but this is more deeper. So dealing ranges and this one. This is dealing ranges. And next, breaking market structure. This is what we're going to look at today in theory and then practical. So break in market structure. And breaking market structure, we abbreviate it as BMS. Yeah, BMS. This is what we're going to look at today. So past lessons. Okay. Yeah. So what is a dealing range? So to define a dealing range, we will look at the two main market structures, that is the bullish market structure and the bearish market structure. Okay. Yeah, let's dive in. So let's start with the bullish market structure. Okay, the bullish market structure. Market structure. Okay. This should be our number one. So what is a dealing range? Okay. Right. So let's say we have a higher low down there. We have just created a new higher high right here, like this. Okay. So this is our higher low. Higher low and a new higher high. A new higher high. Okay. So from this higher low and this higher high, this is what we call a dealing range. Okay. From this higher low, this higher high, this is what we call a dealing range. Okay. Up, down here, this higher low, this higher high, this is what we call a dealing range. Excuse me. Higher low and higher high, this is what we call a dealing range. Okay. So how we deal with the dealing range, we usually mark the dealing range, our current dealing range. So we mark with the trend line. We mark out like this. And we change the color to this. The trend. Yeah, so this is a dealing range between this higher low and this higher high. This is what we call a dealing range. So it's called a dealing range because this is where we look for opportunities, because we are in a bullish market structure, or the market is trading upwards. This is where we look to enter for buys in this range between this higher low and this higher high. That's why we call it a dealing range, because we look to engage within this range between this higher low and this higher high. Okay, so this is what we call a dealing range. Okay, so usually in a dealing range, the market will drop. We call this a retracement or a pullback. The market will drop in a pullback. Then somewhere the market will create a new higher low within this dealing range. Okay, within this dealing range between this higher low, this higher high, market will create a new higher low. Okay, once it creates a new higher low, this is where we hope to buy at, because we are in a bullish market structure. We buy within this range. So once we buy, we rally and we break above this previous higher high. Once we break above this higher high, this is what we call a break in market structure. Okay, once we break above the current dealing range, once we break above the current dealing range like this, this is what we call BMS. The BMS, the breaking market structure, happened right here. Immediately we broke above the previous higher high. This is what we call a BMS. Okay, the BMS. BMS right there. So after BMS, or the breaking market structure, we usually have a new dealing range. Usually have a new dealing range. The current dealing range is between this higher low, which has been created within this range between this higher low and higher high. This higher low. Usually market. Okay, we market the trend line and our new higher high right there. So our current dealing range, dealing range is between this higher low down here, this higher low, and this higher high. So higher low right there, higher high like up here. So this is our current dealing range between this higher low and higher high. And how we utilize this is that we want to look for opportunities, for buying opportunities between this range, between this higher low and higher high. So between this dealing range, the current dealing range, between this higher low and higher high. So usually the market will give a drop, a retracement, or a pullback, call this a pullback, or a retracement within this dealing range, between this higher low and this higher high. Somewhere will give us a new higher low, okay? Then rallies up like this. So immediately the market breaks above this current range between this higher low and this higher high, we have a new break in market structure. So breaking market structure is when the market breaks above or below the current dealing range. Because we are in a bullish market structure, in this scenario, the market broke above this dealing range between this higher low and higher high. So up here, we have a break in market structure. And after having a break market structure, now we have a new dealing range. Our new dealing range is between this higher low and this higher high. So usually mark the dealing range like this, so that you can be aware of where we are at, like in price. So our current dealing range is between this higher low and this current higher high up here. So this is our new dealing range. Yeah. Higher low, this high. So our current dealing range is between this higher low and this higher high. So when we are looking to buy, because we are in a bullish market structure, we look for buys, okay? So we look for buys between this higher low and this higher high. So this is the current dealing range, okay? Don't be confused. Our current dealing range is between this higher low and this higher high. This is our current dealing range between this higher low and this higher high. This is our current dealing range. We look to engage in buys. We look to engage in buys, or we look for new entries for buys within this range between this higher low and this higher high. Let me remove this. So we will have a new pullback or a retracement. We call this a retracement drop within this higher low and this higher high. So somewhere within this range, within the current dealing range, we will have a new higher low, and the market rallies and breaks above the current dealing range, this higher high. So once we break above this current dealing range or the previous higher high, we have a break in market structure. This is a break in market structure. And now we have a new dealing range. That's in this higher low, which has been created, current higher low, and a new higher high right after here. So with this, our current dealing range is between this higher low and this higher high. So the current dealing range is between this higher low and this higher high. The current dealing range is higher low and this higher high. So this is our current dealing range. So because we are in a bullish market structure, we look to engage in buys within this range. So once we start seeing a retracement, we think buys. Yeah. So once we have a retracement like this, a pullback like this, within this range, we will get a new entry for buys. Okay. Then the market rally breaking above the current dealing range. Okay. Like this. So our current dealing range is this. this this. Right, yeah, and right here, after we break above the current dealing range, we have a breaking market structure. This is the breaking market structure right there. And with the breaking market structure, once the market breaks above the current dealing range, we have a new higher high. Usually, when we break above the current dealing range or the higher high up here, we have a new dealing range, which is between this higher low, this higher high right there. So this is our current dealing range between this higher low and this higher high. So when we're looking for buys, we're looking for buys within this current dealing range, between this higher low and this higher high up here. This is our current dealing range in this higher low and this higher high. So within this current dealing range, the market will give us a pullback or a retracement. Within this dealing range, the market somewhere will form a higher low, then rally, breaking above the current dealing range or the previous higher high up here. Then we have a new dealing range with the breaking market structure. Breaking market structure like that. We have a new dealing range that's between this high low and this high high. High low, this high high up here. This is a bullish market structure. So we have started by same. Yeah, and this is the series of the bullish market structure. This is higher low, higher high, higher low, higher high, higher low. Okay, let's start. Higher low, higher high, retracement. Create a new higher low. Rally breaks above this previous higher high, so breaking market structure. And we have a new dealing range between this higher low and this high. A new retracement within this current range, this higher low and higher high. We create a new higher low, rally. Once we break above this previous higher high, or once we break above this current dealing range, we have a new higher high, and we call this a breaking market structure. Higher low, higher high, retracement. We create a new higher low within this current dealing range, that is higher low and higher high, right there. So right here is where we buy. So higher low, rally, break above previous higher high, then we have a new higher high. This is called breaking market structure. So because we have broken the current structure, the current dealing range, that's between this higher low, this higher high, breaking market structure. Like that. And then we have a new retracement within this current dealing range. Higher low, higher high, retracement. We create a new higher low, rallies, break above previous higher high, breaking market structure. So we have broken this structure between this higher low, this higher high. So this is the current dealing range. Once we break above that, we have a new range between this higher low, this higher high, which has been formed by breaking the previous dealing range. That's from higher low to higher high. And this is the sequence of a bullish market structure. And this is how the algorithm, the market, the IPDA moves. This is how it books price. This is how the IPDA is programmed to do. Yeah. All right. So how we utilize this, we want to buy all higher lows because we're in a bullish market structure. We buy at all higher lows. We buy here. We also buy here at this higher low. 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 As for the targets, once we buy at this higher low, we can target the previous higher high. Once we buy at this higher low, once we buy at this higher low, we can target the previous higher high. Once we buy at this higher low, we can target the previous higher high. Once we buy at this higher low, we can target the previous higher high. Buy here, target the previous higher high. Buy here, target the previous higher high. So this is the series of a bullish market structure. And this is how the IPDA, the interbank price delivery algorithm, is programmed to do. This is how it moves in all the markets with currencies, with stocks, stock indexes, government bonds, and the commodities. Everything moves like this. So this was a bullish market structure. We are looking at dealing ranges. Okay. Now let's look at bearish market structures. The bearish market structure and the dealing ranges. Okay. So this is a bullish market structure. Now let's look at bearish market structure. Let's do this on this other side, okay? So let's say we're in a bearish market structure now. The bearish market structure. And as we started by saying, the bearish market structure, we form a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, okay? So we're going to look at the dealing ranges in a bearish market structure and the breaking market structure in a bearish market structure. Okay, let's say we have a new higher low, the market drops to create a new higher low right there, okay? So we have a new a dealing range, okay? Bearish market structure. So we have higher low, lower low is a lower low. Market creates a series of lower lows and lower highs. This is our current lower high, okay? So in a bearish market structure, this lower high and the lower low down here, this is our dealing range, okay? This is our dealing range. This is where within this range, between this lower high and this lower low, this is where we look to engage in sales, okay? So how we do this, we mark out the current range, the trend line, we mark it like, out like this. Then we mark out the lower low, this. So our current dealing range in this bearish market structure is between this lower high and then lower low. So this is our current dealing range within this bearish market structure. The dealing range is between this lower high and this lower low. So if we are going to look for sales, we are going to look for sales within this dealing range, between this lower high and this lower low, okay? Let me delete this, okay. So usually we will have a pullback or a retracement. Get a retracement somewhere within this range, within this lower high and this lower low. We will have a new lower high, then the market drops, okay? So we have a new lower high up here within this range. So I've said we look to engage for sales in this range between this lower high and this lower low. So excuse me, within this range we look for sales, okay? So we sell here then the market drops. Once we break below this current range, right here, this moment we break below this lower low, we have a breaking market structure, okay? That's what we call a BMS. Right there. So here we have a breaking market structure. And after the breaking market structure, we have a new range. The current range is between this lower high, which is, excuse me, please. Within this lower high, and the new lower low, which has been created after the breaking market structure. Once we break below this structure, the current dealing range, that's from lower high and lower low, we break below that, we have a new dealing range. In this lower high, this lower low. How we do this, we mark out the current range like this. Mark out the current range. This lower high, this lower low, like this, okay? So our new dealing range, the current dealing range is between this lower high and this lower low. So if we are going to look for sales, we'll be looking for sales between this within this current range, that's between this lower high and this lower low, this current range. Yeah, so this is our current dealing range. So within this current dealing range, we will have a retracement like this. Then somewhere within this range, we will create a new higher low, lower high, then drop like this, okay? And once we break below this lower low, or below this current dealing range between this lower high and this lower low, as we break there, we have a breaking market structure. So we have broken below this current dealing range. So we have a breaking market structure. And with the breaking market structure, now we have a new dealing range between this lower high, which has currently been created, this lower low. So lower high, right there, and a new lower low. So this is a lower low. So we have a new a new dealing range that's between this lower high and this lower low. So as we are in a bearish market structure, remember we are in a bearish market structure, we're going to look for sales within this range, between this lower high and this lower low, within this range. How we do that, we mark out the current range with the trend line like this, that we can identify our current range. So our current range is between this lower high and the current lower low, like that. Okay? So this is our current dealing range. Our current dealing range is between this lower high, okay, and this lower low. So if we are going to look for sales, we're going to look for sales within this current dealing range. Okay. Usually the market will give us a retracement or a pullback. You can call it a retracement or a pullback within this range. Within this range, the market will create a new lower high, then drop, breaking the current structure or the current range. Okay. Once the market breaks the current dealing range, that's from this lower high and lower low, we have a breaking market structure. Okay. We have a breaking market structure. And there we have a breaking market structure. And there we have a breaking market structure. And with the breaking market structure, we have a new range. The new current dealing range is between this lower high, which has been currently been created, and the new lower low, which has been created after we have broken the previous lower low, so breaking market structure. So our current, the new dealing range is between this lower high, this lower low. Again, we mark the current dealing range. The current dealing range is between this lower high, like that, and the new lower low down here. This is our current dealing range. The current dealing range is between this lower high up here and this lower low down here. This is our current dealing range between this lower high and this lower low. Okay, so within this dealing range, this is where we look to engage in sales. Okay, so once the market starts retracing back within this dealing range, we are looking for sales. Okay, within this dealing range, we are looking for sales. So we will have a retracement or a pullback. So this is a pullback or a retracement within this current dealing range, in this lower high, this lower low. Within this dealing range, we create a new lower high, then the market drops. Okay. Get this out of the way. So once we break below this current dealing range between this lower high and this lower low, we have a break in market structure. We call this a break in market structure. With the break in market structure, we have a new dealing range that's between this lower high up here and the new lower low down here. Yeah. So again, we mark out the trend line to identify the current range. So the current dealing range is between this lower high and this current lower low down here. So this is our current dealing range. So if we look for sales, if we look for sales, we will look for sales within this current dealing range. That's that's from this lower high, the current lower low. So this is our current dealing range. So we look for sales within this range. Okay. So the market rallies back within this range. Call this a pullback or a retracement. Somewhere within that range, the market will create a new lower high, then drops. Okay. So once we break below this current dealing range or the this lower low, we have a breaking market structure like this. And with the breaking market structure, we have a new dealing range. It is between this lower high and the current lower low. This is our current dealing range between this lower high and the current lower low. Okay. So this is the series of bearish market structure. This is how the algorithm is programmed to do. This is how it moves. Okay. In a bearish market structure, this is how the algorithm will deliver price. Creates a new lower low, rallies within this current dealing range, creates a new lower high, drops below the current range, hence breaking the current market structure, creates a new lower low, creates a new lower high, creates a new lower low, creates a new lower high, breaking market structure, it's a new lower low, rallies back, retracement, creates a new lower high, drops, breaking market structure, creates a new lower low, That is back, pullback or a retracement, hits a new lower high, drops, breaks the current range, breaking market structure, hits a new lower low. So how we utilize this? We time for the market to give us a retracement, and we sell in this lower high up here. So sell here. We sell in this lower high, and we sell again in this lower high. We sell again at this lower high. We sell again at this lower high. We sell again at this lower high. So once you sell at this lower high, you can target the previous lower low. Okay, once you sell here, target the previous lower low or just below the previous lower low. Again, once you sell here, target the previous lower low. Right here, when the market is breaking the current range, you exit. Sell at this lower high, target the previous lower low. Sell at this lower high, target the previous lower low. Right here, when you have the breaking market structure. Sell at this lower high, then target the previous lower low right here when you have the breaking market structure. So those are the two main market structures. That's the uptrend, the bullish market structure right here, and the bearish market structure right here. This is the series of a bearish market structure, and this is how the IPDA, the interbank price delivery algorithm, delivers price. Okay. Now the last market structure, we have the ranging market structure. In a ranging market structure, we have highs and lows. Okay, so I just identified in introduction. We have highs and lows, highs and lows, highs and lows. Of course, we don't trade, never trade in a ranging market. Okay, never trade in a ranging market. So in a ranging market, just watch price. When the market either breaks above this range or below this range, that's when you look to MD. So the dealing range in this ranging market is between these highs and these lows down here. This is the dealing range for ranging markets between these highs and lows. Okay, so between these highs and these lows down here. So this is the dealing range for the ranging market structure. So this is the dealing range for ranging market structure between these highs, lows, highs, lows, highs, lows, highs, lows. So we don't trade this, but we trade this. Yeah, trade the bearish market structure. We trade the bullish market structure right here. But if you really wanna trade in this the ranging market, you can sell up here. Can buy at lows, sell at highs, buy at lows, sell at highs, sell at lows. But I would advise against trading this. Okay, don't trade the ranging market. So this is just theory. This is just theory. This is just theory on dealing ranges and break in market structure. So next, we are going to look at the practical application of this. We're going to look at the practical application of billing ranges and break in market structure. All right. Yeah. So I hope you got this. Next is practical for this.